Hi candidates, welcome to another session of manifested online classes. So we are still soldiering on with the syllabus coverage, and in this particular session I want us to look on a subtopic 3 of topic number 5, which is to do with the determination of impairment loss for what we refer as non-cash generating asset in accordance with the IPSAS 21. Now, this particular standard here, that is the International Public Sector Accounting Standard number 21, basically requires public sector entities to do an impairment review at the end of the year if there is some indication, or basically if there is some evidence showing that the non-cash generating asset owned by such an entity could be impaired. Could be what? Could be impaired. So at a later stage, we are going to look on some of the factors, some of the indicators which shows that an asset could be what? Could be impaired. Now, why is an entity required to do that? Generally, when any entity is preparing the statement of financial position, the assets should be recorded in the statement of financial position at an amount equivalent to their recoverable amount. So mean that that value at which an asset is recorded in the company statement of financial position, and basically we know that assets are recorded in this statement of financial position at a value which is called the carrying amount. This standard requires that this particular carrying amount should always be equal to recoverable amount. So what is the recoverable amount? Recoverable amount essentially is the amount at which now an entity can be able to receive if it sells an asset currently. But in some cases, it may happen that this particular recoverable amount may be less than the carrying amount. If that is the case, then this particular standard comes in and it requires now a public sector entity to reduce the carrying amount to an amount which is equal to recoverable amount, of which now the difference between those two values, carrying amount and recoverable amount, is then known as the impairment loss. But we're going to look on how we determine that. Let's first of all we do some introduction here, and we say that IPSAS 21 IPSAS 21 requires public sector entities to carry out impairment review if there is evidence showing that assets or its assets could be impaired. And this particular standard here, that is IPSAS 21, it basically relates now to impairment review on what we refer as non-cash generating assets. So what are non-cash generating assets? Non-cash generating assets are basically those particular assets which are owned by the public sector entities and which are not expected to generate any commercial return. So therefore, this standard requires that if there is some indication or basically some evidence showing such asset could be impaired, then this particular entity should go ahead and do what? Carry out an impairment review. So basically this impairment review entails comparing two values. So we can say this entails comparing the carrying amount, amount of an asset, and specifically in this case we are referring to non-cash generating assets of a non-cash generating asset and its recoverable service amount, and if the recoverable service amount, maybe we can abbreviate the recoverable service amount using this abbreviation, recoverable service amount. So if the recoverable service amount is less than carrying amount, amount, equally we can abbreviate this carrying amount here using capital CA for carrying amount. And if the recoverable service amount is less than a carrying amount, then the asset is impaired. The asset is what? Is impaired. So, and if the asset is impaired, what a public sector entity should do is basically to proceed and determine what is known as impairment loss. So, how is the impairment loss determined here? So, let's look on the formula for that. So, impairment loss is equal to carrying amount, which is also known as the net book value, abbreviated as NBV, minus the recoverable service amount. Recoverable service amount. We are going to define some of these particular terms here. So therefore, the impairment loss here we are saying is the difference between those two values, the carrying amount, which is also the net book value, and the recoverable service amount. Maybe we can look on before we look on basically how we determine this particular impairment loss using various methods. Maybe first of all we can define some of these particular terms here, and we say carrying amount is the net book value of a non-cash generating asset and cash generating asset, i.e. it is the value an asset is carried in the statement of financial position. So therefore we are saying that the carrying amount, that is CA, is the same with the net book value of an asset, and we are saying that this is basically the value at which an asset is carried in the statement of financial position. So how do we compute this carrying amount, or how do we compute this particular net book value? So let's have the formula for that here. Net book value, or the carrying amount, this one is equal to the cost minus accumulated depreciation, So that is how we determine the carrying amount. Then from there, here we are also talking of another term here, which is the recoverable service amount. We have a recoverable service amount, and actually this is defined under this particular standard here to be the higher of two values. So we say that the recoverable service amount, this is the higher of non-cash generating assets and cash generating assets. Number one, we have something called the fair value less cost to sell, fair value less cost to sell, which is also known as NRV, net realizable value, or number two, something called the value in use. Of which in this case, when we talk about the value in use, this is defined differently from the definition of value in use under IS 36. So value in use under IPSAS 21, this one is defined as what? As the present value. So we can say that this is the present value of remaining service potential, of a non-cash generating asset. A non-cash generating what? Asset. So that is the definition of value in use, which is basically different from how we define the same term at the IPSAS what? At the IPSAS, not IPSAS rather, but at the IS 36. So therefore what we have said here is that this particular standard, IPSAS 21, requires any public sector entity at the end of each year to determine or to carry out impairment review if there is some indication or basically some evidence which shows that such asset could be impaired. So we are saying this particular impairment review entails comparing two values. The first value is the carrying amount and what? The recoverable amount. In this case, we have said if the recoverable amount, this one is found to be less than the carrying amount, it is obvious that that asset is impaired. What an entity should do, what a public sector entity should do, is to determine the amount of impairment loss and also recognize that impairment loss as an expense in what refer as a statement of financial what? Performance, statement of financial performance. So, but equally, it is also important for you to know how do we determine these two values which you are comparing here, the carrying amount, recoverable service amount. Carrying amount, we are saying, is the same with the net book value of an non-cash generating asset, which is equal to the cost minus accumulated depreciation. And then how do you determine the recoverable service amount? We are saying you take the half of two values, the fair value less cost to sell or net realizable value, and then the value in use. Now, value in use, we are saying, is the present value of the remaining service what? Potential of non-cash generating asset. And therefore, this particular standard here, IPSAS 21, basically provide three methods, or in other terms, three approaches, which can be used by a public sector entity in terms of determining what refer as the value in use. But we are going to look on those particular approaches, those particular terms, which may be used in terms of determining the value in use at a later stage. But before we do that, I want us to look on, or we define some additional terms here. We look on definition of additional terms here. Definition of terms. Basically, these are additional terms we need to define, because already we have defined some few terms here, like carrying amount, like the recoverable service amount, and so on. So the other term we need to define here is something called a cash generating asset. Cash generating assets. So when talk about the cash generating asset, as the name suggests, this is basically any asset which is held by a public sector entity and which is expected to generate some commercial returns. Which is expected to generate commercial what? Returns. So therefore, you can say that this is an asset held by a public sector entity, and which is expected to generate commercial returns, to generate commercial returns. So in this case, when we talk about an asset generating commercial returns, it means that that particular asset generate now cash flows. Generate what? Cash flows. And generally, these are those particular assets which are owned by some entities which are under the control of the government, which are known as government business enterprises. Government business enterprises are those particular entities which are under the control of the public sector entities and which operate in the same way, just like the profit-oriented entities. Profit-oriented what? Entities. Maybe a good example of this, we can talk of something like Kenya Railways. So Kenya Railways, basically we can say it operates like any other profit-oriented what? Entity, though that particular entity is under the control of the government, is under the control of what? The public sector entity, because we know something like Kenya Railways is not reliant on continued government funding for it to be a going concern. So it is expected that the revenue which is generated by that entity, Kenya Railways, is able to sustain its operation. So therefore, that is a good example of a government business enterprises, and therefore the asset which it owns, e.g. the trains and so on, those assets are basically regarded as or referred to as the cash generating what? Assets, simply because you are saying those particular assets are expected to do what? To generate some commercial returns, or in other terms, they are expected to generate some what? Some cash flows. So we know that if, for example, today you want to travel from Nairobi maybe to Mombasa using a train, you have to pay for that. So basically it means that Kenya Railways generate now some revenue from those particular what? From those particular trains and so on. So in this case, we proceed and we say that holding an asset, holding an asset, we have a full stop there, holding an asset to generate commercial returns, means that the asset is deployed in a manner consistent with that of profit-oriented entities. Profit-oriented entities. So holding an asset to generate commercial returns means that that particular asset is deployed, or in other terms, it is used by that public sector entity in a manner which is consistent with that basically deployed by what? Profit-oriented entities. Profit-oriented entities are those particular entities which operate with an objective for making profit, and anytime such an entities own an asset, those particular assets are deployed, are used in a manner, or basically they are used in order to generate what? To generate cash flows. To generate what? Cash flows. So maybe further we can proceed and we say that holding an asset to equally generate commercial returns, returns indicates that the entity intends, number one, to earn commercial returns from the asset. Number one, earn commercial returns from the asset. And number two, that the entity or basically in this case, earn commercial returns which is equivalent, or basically which reflect, maybe you can just put it like that, which reflect the risk involved in holding that asset, risk involved in holding the asset, So mean that holding an asset to generate commercial returns mean that the entity here intend to generate commercial returns, intend to generate some cash flows, and basically in this case we are saying that the cash flows which are to be generated are always equivalent to the risk which are involved in holding what? Such an asset. And finally, number two, we say that the entity intend to do what? To generate cash flows from the asset. So basically that is the meaning of what you refer as the cash generating what? Asset. Basically this is one of the term which you may be required to define. There was a question which was tested some time back whereby the examiner was requiring the definition of this term, and actually the marks allocated in that question were 4 marks. So basically that what was expected of you. So the other term we also need to define here is non-cash generating assets. Non-cash generating assets. And basically we say that this refers to any other asset other than the cash generating what? Asset. So we can say this is any other asset, other than a cash generating asset. Other than cash generating asset, i.e. It is not expected to generate commercial returns. Or in other terms, to generate what? Cash flows. So therefore, these are those particular assets which are owned by public sector entities and which are not expected to generate any form of cash flow. A good example is whereby, for example, the national government or even the county government may construct some classes in a public school. So those particular classes which are constructed in a public school, we know that they are assets but which are not expected to generate commercial returns. Equally, if, for example, like the national government or even the county government or even a parastatal, maybe buy a school bus or even a certain public school, buys a certain or buy a school bus, that particular school bus is a non-cash generating what? Asset. It is an asset which is owned by a public school, either a primary school or a secondary school, but which is not expected to generate any form of what? Commercial return. So that is a non-cash generating what? And cash generating asset. So maybe from there we can proceed and we define the other term, which should be term number 3. The other term number 3, which is government business enterprises. Government business enterprises. And these one are abbreviated as GBEs. So these are those particular entities which are under the control of the public sector, and this one, they operate in the same way, just like the profit-oriented entities. And actually, you have said any asset which is owned by these particular entities here is a cash-generating asset. Is a cash-generating what? Asset. So therefore, we can say that this is an entity with the following characteristics. With the following characteristics, or basically you can talk of with the following features. Number 1, it has powers. It has powers to contract on its own. Number 2, we say that it is controlled by public sector entity. Basically, a good example of this is something like Kenya Railways. Kenya Railways operate under the Ministry of what? Of Transport. Is basically a good example of a GB. It's basically, it has powers to be able to contract it on its own. And also on the other hand, you have said that Kenya Railways operate on something called the full cost recovery. In other terms, it is not reliant on continuing government funding for it to be what? To be a going concern. So therefore, feature number 3, we can say it do what? It sells goods, stroke services at full cost recovery. at full cost recovery or at a profit. At a profit. And number 4, we can say it is not reliant on continuing government funding, funding for it to be a going concern, for it to be a going concern. A going what? A going concern. So basically this means that GBs are not reliant, or basically they do not receive allocation from the national government on annual basis for it now to be a going what? A concern. So those are basically now the various features, or basically the various characteristics of what you refer as the GBs, or the government business what? Enterprises. Now before you look on how we determine the value in use. Remember, I say that in determining the value in use, there are various approaches which may be used by the public sector entity. Before we look on that, I want us to look on some of the factors which indicate that a non-cash generating asset may be impaired. So we look on the indicators of impairment. Indicators of impairment. So when talk about indicators of impairment, those are or these are those particular factors which may show that a non-cash generating asset could be impaired. And if this particular evidence, or basically these particular factors exist, then we are saying what a public sector entity should do at the end of the year is basically to carry out impairment review compared to the two values, the carrying amount and the recoverable service amount. If the recoverable service amount is found to be less than the carrying amount, then it means that such a public sector entity should do what? Should proceed and determine now what it refers as what? The impairment loss. So these particular indicators of impairment are generally classified into two categories. Number 1, we have the internal indicators of impairment. So generally, we can say these are like those indicators, those factors which indicate the asset could be impaired and which mostly are under the control of the entity. So number 1 is what referred as the physical damage. Physical damage of an asset. Damage of an asset. Number 2, we have what referred as indication. Indication that service performance of an asset, service performance, or generally the performance of an asset, service performance of an asset, is worse than originally expected, expected. Number 3 is where we have decision which has been made to halt, or basically to stop the construction of an asset. Decision to hold. To hold is the same with this, to stop the construction of an asset. Construction of what? Of an asset. So basically these are some of the internal indicators of impairment. So anytime any of this particular factor exists, then it shows that the non-cash generating asset could be impaired. And we are saying, according to IPSAS 21, a public sector entity at the end of the year should carry out impairment review because there is some evidence that the asset could be what? Could be impaired. So basically these ones we have referred to them as internal indicators of impairment. Then from there we have the external indicators. So external indicators, basically these are those factors which shows that the asset could be impaired and which are not purely under the control of what? Under the control of the public sector entity. So the external factors which shows that a non-cash generating asset could be impaired include the following. Number one is cessation of demand of services provided by the asset. In very simple terms, this means that the services which were provided by the asset, those services are no longer needed. Maybe, for example, the national government had constructed some classrooms, and maybe that particular school has been closed down, maybe due to insecurity and so on. So it means that the services which were being provided by those particular assets are no longer what? Needed. So that may shows that those particular assets could be what? Could be impaired. Number two is where we have adverse changes in technological market. Adverse changes in technological market, or maybe technological environment. So this whereby, for example, if a public sector entity maybe own an asset like a machine, there is a more advanced machine in the market due to advancement in technology. So that is still another factor which indicate that that particular machine which is currently owned by the public sector entity could be what? Could be impaired. So therefore, these are basically some of the external factors which indicate that the asset could be impaired. Therefore, what you have said is that IPSAS 21 requires that anytime there is an evidence, there is a factor which shows that the asset could be impaired, then is a requirement that a public sector entity at the end of the year should proceed and carry out impairment review, in which case we said carrying out impairment review entails comparing two values, the carrying amount of the asset and its recoverable service amount, whereby we have said if the recoverable service amount is found to be less than the carrying amount, then an impairment loss should be what? Should be determined and also recognized as an expense in the statement of financial performance. Now, I want us to look on the various methods of determining the value in use, methods of determining the value in use, at the IPSAS 21. But even before we look on these methods, it is important to recall what we covered in topic 1 of financial reporting and advanced financial reporting and analysis. We looked on how private sector entities should determine impairment loss in accordance with this particular standard IS 36. And we said the value in use at this particular standard here is equal to the present value of the expected cash flows to be generated by what? By the asset. But remember here, IPSAS 21 deals with impairment of non-cash generating assets. Non-cash generating assets. So meaning that this asset here do not generate any cash flow, do not generate any what? Cash. So therefore, the value in use, obvious, cannot be determined by discounting the cash flows which are generated by such what? An asset, simply because this asset do not do what? Generate cash flows. And therefore, what IPSAS 21 has done is that it has provided 3 methods which may be used by a public sector entity to determine the value in what? In use. So therefore, we can say that the value in use is determined or we can say the value in use can be determined using any of the following 3 approaches. So the first approach is called the depreciated replacement cost approach. So under this particular method here, how do we determine the value in use? So the value in use here is determined, number one, by taking the replacement cost. What is the replacement cost? Replacement cost basically is the cost which will be incurred by a public sector entity in terms of replacing an asset which is impaired. If, for example, we have like a primary secondary school which owns a school bus, and that particular school bus has been involved in a road accident, it has been declared as a write-off. So that particular secondary school may intend to acquire a similar bus with a similar capacity. So how much cost will be incurred in terms of acquiring a similar bus currently with a similar capacity? So that cost is what we refer as the replacement cost. So therefore, under this particular method here to determine the value in use, what we do is that we take the replacement cost, which always will be given to you, will be provided to you by the examiner. And then what we do is that we depreciate this particular replacement cost. We depreciate this replacement cost for an equivalent duration. The asset which is now deemed to be impaired was depreciated. Was what? Depreciated. So depreciate this replacement cost for an equivalent duration. The asset which is now deemed to be impaired was what? Was depreciated. Whatever you get here is the value in use. The value in use. So then we have the other method or the other approach used to determine the value in use. Number two, we have restoration cost approach. Restoration cost approach. So under this particular method, the value in use is determined as follows. So first of all, we take the replacement cost. I've explained what is replacement cost. Replacement cost. We depreciate it for an equivalent duration. The asset which is deemed to be impaired was depreciated. So mean that this will less accumulated depreciation. Accumulated depreciation. Whatever you get here is known as depreciated replacement cost. Depreciated replacement cost. And then to this we proceed and we less something called the restoration cost. So what is the restoration cost? The restoration cost is the cost which is incurred by a public sector entity in terms of restoring an asset to its pre-impaired state. It's a cost which will be incurred to restore the asset how it was before it was impaired. Generally, this is the repair cost. This is the repair what? Cost. Whatever you have here is now what we refer to as the value in what? In use. And then we have the last method, the last approach used in determining the value in use, and that is the service unit approach. Service unit what? Approach. So under this particular method, we determine the value in use as follows. The value in use is determined as follows. First of all, just like what you have done up there, we take the replacement cost. The replacement cost. We have to depreciate this for an equivalent duration. The asset which is deemed to be impaired had been depreciated. So to this we less the accumulated depreciation. We less accumulated depreciation, and we get now the depreciated replacement. Depreciated replacement cost. So once we have that depreciated replacement cost, what we do is that we have now to adjust this with the remaining service potentials for us to be able to get what? To get the value in use. So to get now the value in use, so we take this depreciated replacement cost, assuming now it is A. It is A. So we take A, and then we multiply this. We multiply this with the proportion of the remaining service potential of a non-cash generating asset. When talk about the service potential of a non-cash generating asset, or the remaining service units, this should be remaining service units. Okay. So remember, I've said we take this one, depreciated replacement cost, we multiply that with what? With the proportion of the remaining service units, remaining service unit. So when talk about the remaining service unit, we are talking of those particular units of a non-cash generating asset which are still providing services. Let me give a good example of that. We can be told that a certain public sector entity own a building, and maybe this particular building has, for example, 8 floors. But due to a number of reasons, this particular public sector entity has been ordered, for example, by NEMA, not to occupy the top 3 floors. The top 3 what? Floors. So it means that the remaining, or the units of this particular building, when talk about the units, we can talk of the floors. The floors which are being used are 5. So therefore, we say that the remaining service units are 5 out of what? 8. This is now what we refer to as the proportion of the remaining service units. So once you have gotten now this depreciated replacement cost, you come and you multiply it with the proportion of the remaining service unit. Like in our case, the proportion of the remaining service unit will be what? 5 out of 10. 5 out of 8. And basically that will give you now what we refer as the value in use. So therefore, according to IPSAS 21, there are those 3 approaches, those 3 particular methods which may be applied in terms of doing what? In terms of determining the value in what? In use. So here is today's assignment. Question 1, define impairment of non-cash generating asset in accordance with IPSAS 21. Question 2, with reference to IPSAS 21, impairment of non-cash generating asset. Roman 1, explain the meaning of cash generating asset. Number 2, define a government business enterprises. Roman 3, analyze the factors that could indicate that the asset is impaired. And then we have the last question, which is question number 3. Explain 3 approaches an entity can use to determine the value in use of a non-cash generating asset in accordance with IPSAS 21. So for now, I want us to stop at that point. Once we meet in our next session, I want us to look on some illustration questions which are based on the past paper questions regarding how to determine the impairment loss under those 3 approaches: the depreciated replacement cost approach, the service unit approach, and also the restoration cost approach. For now, is a bye.